Hello, everyone, and welcome to the Hardcore Finance Podcast with Alex Chizik and Shimon Lazarov. Today, in the midst of market changes, both in the stock market and in the crypto market, we want to talk about what we can learn from the history and how we can apply that into the future. Can we learn anything? Do PE ratios matter? What are PE ratios? What other aspects of past performance can we apply to the future? And how has the market changed today and how is it different than before? With that said, let's get going. So, Shimon, we've talked a lot about markets, market performance, opportunity cost, both on many of our musings. But we haven't really talked about, well, what can we do with the learnings of the past and how can we apply that to the future? And maybe we can't. Maybe we can. So I want to jump off there and maybe ask you, when you think about investing, do you think about past performance? Do you judge that at all? And if you do, what do you look at to think about your future actions?
Yeah, that's a very good question, Alex. I mean, it's very common for people to quote things like, all things being equal, ceteris paribus, as it's called in, I believe it's Latin. But basically, yeah, all things being equal, if one thing changes, another thing is supposed to change. So, for example, when people quote PE ratios, which is the ratio between the price of a stock and the earnings of that stock, they will sometimes say things like, oh my God, the PE ratio is completely unsustainable, right? Like if I look now at the S&P 500 PE ratio, it's 38.29. And there's only been like two other times in the history of the S&P 500 where it has been higher than 38.29. One was right before the 2008 crash, and then the other one was somewhere close to the 2000 crash. So many people in financial Twitter and other places are saying this is completely unsustainable. Look, like every other time where we had this price to earnings ratio, we ended up crashing. And so that's how they will justify the fact that now the market is overheating. And I actually think this is a wrong approach. And I'm happy to tell you why. But before I do that, what do you think about this approach, saying there's only been two other times when the PE ratio of the S&P 500 was so high and like it crashed afterwards, so the market's going to crash? What do you think about that?
Yeah, it's a good question. And I'll be a little bit provocative. I think three things. One, a lot of the news, stock market news that you get on, your phone and that you can read online is frankly bullshit. It's noise, and the people and reporters who have to report on this daily assign or need to assign some sort of driver to a performance of the stock. Sometimes the daily performance of a stock is just what it is. It's fear and greed, it's noise, there's daily fluctuations. Other times it can actually be driven by something. And so it's a very convoluted machine really that drives the stock performance. Sentiment of folks, earnings, news, just fear and greed in the market, and many, many more. I think that's part one. Part two is, a lot of times people say things like you said, the P ratio is high or is low, without taking a context of the situation, without looking at a situation against the backdrop. And so what I hope we talk about today is, how do you build in the macro backdrop or the company's performance backdrop into what is actually happening? So yeah, the PE ratio can be high, but maybe it's okay that it's high because of X, Y, and Z. Right. So in and of itself, it's a interesting thing to say, but it's meaningless without the backdrop. And three is, unfortunately, a lot of the articles are clickbaity, and just reporters have to sell articles, have to sell clicks, have to sell the attention for eyeballs.
Yeah, so let's say I just want to push you. Let's say ignore the clickbaity articles. Like, someone actually has this argument, which is like the only other two times where we've seen price to earnings ratio that are that high, the market crashed. What would you do with this information as an
Nothing.
investor?
I would say, okay, that's interesting, but I will go and do my own research because, in and of itself, that is just one piece of the pie, one piece of the puzzle, and there are many other pieces. Would you react on this information?
Yeah, no. So I'm exactly what you said. I couldn't agree more. So the first of all, the idea is that price to earnings ratio basically can be driven by something like future expectations, right, of the earnings to go up, which is reflected in the price but hasn't materialized yet in terms of earnings. So for example, if we look at the price to earnings ratio of Tesla, right, and it's like 129x, 129 times. So when you're buying a Tesla stock today, you're paying 129 years of its current earnings, which sounds really crazy if you think about it. But then I'm looking, for example, at the Amazon price to earning ratio, and it's like 92. So when you're buying an Amazon stock, right, you're paying 92 years of earnings in the current stock. With Amazon, it's very clear that basically what you're buying is not the current earnings, but what you're buying is the belief that Amazon is working on things that will generate much, much higher earnings in the future. And so that's why the PE ratio is high. Same with Tesla, right? Like, I'm not a big fan of Tesla in terms of like individually buying the stock, but like people who choose to buy the stock, it's all about basically, hey, we believe Tesla can do a lot more. We believe that Tesla is not just a car company. Currently, they're manufacturing cars, but in the future, they can do all of the logistics of all of the world with their self-driving technology. So that's like one thing about individual companies. Now, the other thing is when we look at the stock market as a whole, the argument becomes a little bit more interesting because it says, look, we can't like have all of the stocks, right, being mispriced like that. And my pushback on that is that probably the high price to earnings ratio is taking into account future money printing that will happen by the government. So basically, we're saying, yes, at the current levels of money printing, maybe it's pretty high. But what if I were to tell you that the government would increase the money supply by like 15% every single year? Then suddenly paying that multiple may not be like a bad decision. And then the third thing about like when people say every previous time where this happened, it crashed, my pushback to this is nothing like this year has ever happened in the history. Like the government has never printed 30% of the money supply in 1 year in the past. So I think everything that happened in the past is not necessarily going to repeat itself because the conditions are different. So that's how I would react to that.
Yeah, so let's take today's market aside for a second. There's two interesting things in what you said, and let's parse it out. One is money printing. Let's get back to that. The first thing is, at which point can you look at the P/E ratio and say, you know what, now it's a bubble versus no, it's still okay because Tesla can create the logistics of the world with self-driving cars and so on, right? And maybe just before you answer, as part of that is, at what point do the current price of a stock is really essentially ultimately the discounted cash flows of or future cash flows of that company. And do you look at a company in perpetuity, which means forever? Do you look at a company with a 5 to 10 year horizon? Is that too short? What's the horizon of a company that we should be evaluating their stock or the enterprise against? Because a 10-year-old digital company is a dinosaur in the space versus before, if you rewind to the 1950s and 20s and so on, a 56-year-old company was still considered fairly young. So the horizons have changed, right? So how do we look at it and say, yeah, this PE ratio makes sense versus, oh my God, this PE ratio is way too high. It feels like we're in a bubble.
Yeah, I mean, you raised two really good points. One is the discount of future cash flows. So something happened now where it hasn't happened since World War II, which is the government basically saying we will have yield curve control, which basically means we will make sure that the treasuries of the US will trade at very, very low interest rates. And every time the interest rates for the treasuries go up, we're just going to buy them with printed money to bring the interest rate back down. So the idea is like, for those of you who don't know, when you look at a bond, the price and the interest rate are inversely correlated, which means that if the interest rate goes up, the price of the bond goes down. And so the government will just say, oh, the price is cheap. We're just going to buy as many as we can, not as many as we can, as many as it takes in order to increase the price of the bond. So that's one thing that hasn't happened since World War II. And so that means that the discount rate for the cash flows of the company is very close to zero, which means that the net present value is very high. So that's like one really good point that you make, which is like, yeah, the stock index and the stock prices of individual stocks are really, really driven by this yield curve control. Then about the longevity of the company, look, I don't know. It's a good question because like you could make the case that modern companies survive less on average than traditional companies. And I think I've seen data somewhere to support that. But you could also make the case that if you look at the top 10 companies with huge network effects, maybe those network effects will protect them well into the future. So it's really hard to know. I don't know actually that's why I love investing in an index and not picking individual stocks, because then that question becomes kind of irrelevant.
Yeah, so it's interesting. When I was back in my former life, and I won't mention which company this was, but when I actually did M&A deals and did valuations, we didn't apply any value to anything beyond a 10-year horizon. And this is especially, again, it's very industry specific, but in the technology industry, this is very, very it's a bit of a like an unwritten rule, because past 10 years, not only do you not know what the company will do, but you also don't know how the company will pivot and how the tech will pivot. At the current rates since the 90s, our technological advances have been so fast that unless you have a like a super behemoth like a Microsoft or a Google or a Facebook or an Amazon, which just eats up everything in its path and accrues more and more value to its shareholders, the other companies, it's very hard to compete for the long term. You have to really pivot. A great example of this is Slack. Slack came along and said we can do business and productivity collaboration in a much better way. They created Slack. It was a great tool, went public. Microsoft came in and created Teams, which is a Slack ripoff, a Slack compete. And the Slack's business model and runway has fundamentally shifted, right? Fundamentally shifted. And so M&A, mergers and acquisitions, are a little bit different than valuing a stock or a company. But I'm from a corporate finance perspective, a corporate development perspective, on an M&A deal in the technological space. And our listeners would know that Shimon and I are pretty big on tech, not only because it's an important industry, but because it also permeates and drives other industries. That anything beyond a 10-year horizon is very, very hard to value. Again, it could be a little bit different when you're investing. And so when I invest and I typically look at performance, I do look beyond a 10-year horizon, but I look at the stock or the company to see if it has scale and network effects that will help it accrue value to what it's doing. So again, Amazon is an example, Microsoft is an example, Nvidia is a stock that I really like. They have a lot of great chip making prowess, and the chips that they make, the more they make them, the better they become. And if I believe that these chips are going to be used more and more in the future for more of this type of compute, I'm going to invest in them because they will become better and better as their market share and use cases grow.
Yeah, I completely agree. So basically, back to our point here: how is the past relevant, and how is the past not relevant to current valuations? So we mentioned that PEs are not really relevant because of the money printing and because of the yield curve control. Another interesting thing is when you think about basically the technology just as an industry, right? I don't think it's like far-fetched to say that technologies accelerate, right? That's like that's the main kind of thesis of Ray Kurzweil's, the singularity is near, and all of these books. And basically, the whole idea is that like we use the latest technology to research the next technology. So, for example, it would be much, much easier to figure out an efficient way to do machine learning with the latest computers than like, 10 years ago when we had like weaker computers. If you had to solve that same problem of like figuring out a machine learning algorithm, it would have been much harder. Then once you have the machine learning algorithm, then you use that algorithm to build the next computer. So in a sense, I could see, right, technology accelerating. Now, if technology accelerates, then past PEs have no meaning today, right? Because like if you look at a company like, for example, I don't know, like Exxon or some kind of like oil company, there are natural limits to how fast they can expand. There are natural limits to the speed of which they can, like have a network for distribution of their oil, have enough consumers buy the oil, all of that. When you look at something like WhatsApp, right, they just like overnight can push product to 1 billion people. And so I think, again, when we look at PEs, that's something that people completely disregard, which is technology is accelerating, which means that you would expect for the same price, you would actually expect more earnings. Basically, I think the trend in price to earnings ratio should be going up in technology, which is something that surprisingly I haven't heard anybody talk about. Like I've heard people talk about the fact that technology has higher PEs than non-technology stocks, but I haven't heard anybody say the price to equity ratio of technology stocks should be increasing every year, all else equal.
So that's an interesting point. I haven't heard that as well, and it's. I'm kind of reacting to this live as well, so I'm racking my brain because it sounds intuitive to me and it sounds right. I guess the first question I have is at what point, at what rate should it accelerate, right? At what rate is because there are some stocks that truly are overweight or truly are completely inflated, right? And then they come crashing down, and there are many examples of this. So at what PE ratio acceleration is fine and which one isn't? And also, how do you view that with the macro, either headwinds or tailwinds? So, tailwinds meaning the macro environment is favorable to the stock, so everything rises, and headwinds is the opposite, right? It stops you from growing. So, how do you parse those things out and say, yeah, this is a good growth in PE ratio, it's solid? Is it X% per year, or do you just kind of look at it on an aggregate basis?
Yeah. I mean, I think it's very, very individual for different companies. I remember once in my previous life, I was looking at like a large CPG company that was selling chocolates. And like, the sales were declining, and it's like not because of the product being bad. It's just because people eat less chocolate. Like it's just like a trend. So that's like an example of like headwinds, which is like the more I talk to you and the more kind of I think deeply from first principles, I would kind of stay away from industries where like you have a limited capacity for growth. For example, I would stay away from industries that have to do with food, because like there's just like so many calories that each person can eat per day, right? I would stay away from, I don't know, I'm just thinking now about, this is like a very interesting filter to look at industries through, like, is the growth capped or is the growth uncapped? For example, if you look at like healthcare, I think that's actually an example of something where the growth is uncapped once we go to longevity and like performance improvement, as opposed to just like fixing when something hurts. So I think healthcare is actually, you can grow infinitely. Education, I don't know, like, is education something where you just get the education you need in order to perform a job? Or is education something where you can just like be a lifelong learner and you just derive pleasure from it, in which case it is unlimited? So I think that's how I would analyze an industry. Like oil and commodities, I really don't like these stocks because, again, betting on commodities is kind of betting against human innovation, right? Like any commodity that's expensive to make, it's just a matter of having a new technology to like extract it better or refine it better, or even like the energy costs, like many commodities, energy is the main input in them. If the energy cost drops, then the price of commodities will drop. So I would definitely stay away from those as well.
Are there any pieces of, like, going back to our, can history be an indicator of the future? Are there any KPIs or data points, historical data points, that you look at that indicate future performance? So I'll give you one that I look at all the time when I evaluate individual stocks. And I know the difference between us and for our listeners is Shimon is much more macro than I am. So he's thinking about indices and industries. And I agree with that, but I also like to make some bets on certain companies. And this is just is my center of gravity from my previous life in M&A and in corporate strategy of kind of big Fortune 100 companies. So I've learned to analyze, and that's just kind of where I like to go. It's not any better or worse, but it's just a different investment direction. And so when I look at companies, and I really, really use this to judge future performance, is I look at two things. I look at organic or inorganic growth. So organic growth meaning, did the company grow by itself, right? Or inorganic, did it acquire others in order to grow? And when there is inorganic growth, I look at I look at the leadership very, very closely. So who are the people that are driving the company, that are able to take these inorganic purchases, so mergers and acquisitions, and integrate them well into the parent company. So when one company A, call it Google, buys a smaller company, can they integrate them and then accrue benefits to the parent company? That for me is very, very effective. The other thing I look at is leadership overall. How have leaders been able to create overall growth and innovate? So there are, my opinion, when I look at leadership of companies, there are two types of leaders, executives. Ones are visionary and ones are operational and executionary. So Steve Jobs, for example, visionary leader. COO, Tim Cook, very executionary. Same thing with Bill Gates and Steve Ballmer. When those flip and the executionary leader becomes the leader of the company, they typically execute very, very well. So optimize for cash, but don't innovate for the future very, very well. And Apple's been hitting this innovation trap. Microsoft notoriously missing the phone with Steve Ballmer. So I really look at leadership to understand how have they performed in the past, what type of leader it is, and are they able to actually integrate inorganic growth, so mergers and acquisitions. Shimon, from your perspective, do you look at anything historical, whether micro or macro, in order to indicate future performance?
I mean, again, it's hard for me to look at individual stocks. I'm really, really not good at that, I think. So I think, yeah, I don't know if those things like the leadership is
What
very.
about on the macro level? Like, do you look at macro market trends, or do you just take anything that comes and you say, well, the history is what it is, and the future will be, let me analyze the future. So for example, cyclicality, right? Do you look at cyclicality in an industry and say, okay, well, maybe there's seasonality to buying, or there's cyclicality to the way tech is emerging, or the way consumers choose to spend their money? I don't know. I'm kind of picking your brain here, but giving you some ideas that you could look at.
Yeah, so actually, both of these things are things that I don't look at because I think that the second order effects are really, really hard to predict. Like, for example, coronavirus hit, right? And I was monitoring the economic news very, very closely. So the idea is suddenly all of these restaurants were closed, all the travel was closed. Like there were some sectors that were clearly hit, right? And then that's all the people, like the news were talking about that, the waiters who like are furloughed and so forth. But what they missed two really, really important points, which is like, one, the vast majority of people who were furloughed got more money from the government than they got during their job. So that means it was really good for their savings rate. And then the other thing that people missed is like consumption that was deferred or like canceled in some industries just went to other industries, like all of the Amazon purchases and like Alcohol is doing really well. So when you look at it from an index perspective, I think even something like the coronavirus was very hard to predict how it will affect the index as a whole. Now, yes, if you go to specific sectors, you could probably do some analysis there. Although, again, that's just not my forte. I don't like thinking about this. Now, cyclicality, I don't like, because I think a lot of that can be front run. So a lot of the cyclical things, it's like as soon as people are aware of a specific effect, they will front run the increase before it comes, and that will basically kind of dampen the cyclicality in terms of price. So yeah, haven't seen something there too much. One thing though that I really like about looking at the past is like leadership, like big policy changes. So for example, it's usually an idea of like buy the rumor, sell the news situation. So if there's some kind of change in leadership, and then people think that it will affect the markets in one way, I usually go against that bet, and it usually works out pretty well. So I famously told many of my friends that after Brexit, I was very bullish on the UK economy, not because Brexit is good for the UK economy, but because like people were pricing in all of these like crazy scenarios, saying, "Oh my God, we're going to lose all these deals with the European Union," and it's like, no, you'll just move to bilateral deals instead of multilateral deals. So that was a sense where you look at the past and you say, "Oh my God, people are predicting like apocalypse." And then you can make money by going against them. I think this is what we did kind of with the Trump versus Biden episode, when we recorded like what we think would be the effect on the markets. And basically, beyond disagreeing of like who would be better, we just agreed that no matter who gets elected, the stock market will go higher. So that's kind of the extent at which I look at trends. But I think in your wheelhouse, when you analyze specific companies, it's much more relevant. Have you had any success of like looking at the past performance of a specific company and then acting on it to profit?
Um, yeah. So a big one is Microsoft. When Satya Nadella, the new CEO, came in and started making changes, started making culture changes, for full disclosure, I worked at Microsoft, and I saw some things that he's done inside that were great, but I'm talking about Microsoft long after I left. So I wasn't privy to anything confidential other than looking at the leader and knowing that the leader, how he's regarded, and saying if he was able to make the early changes and they were successful, um, then I want to make a bet on him. Another example is a great example is Adobe. So Adobe basically took their whole model and they transformed it from a kind of paper software uh, business model to a SaaS model. And I greatly admire Adobe and their whole executive team. And I'm betting on Adobe to be big in the future, right? Similar to, for example, I'm kind of in and out on Tesla. And now that I'm in and out on Musk, because I do believe that he is a great visionary, although he's a celebrity status that I think actually detracts from what he is and what he isn't. And the reason why I'm in and out on Tesla is not because of Elon, but because he could be distracted. Is he making rockets? Is he making cars? Is he commenting on Twitter? Is he railing against Trump? Like, what is he
All
focused
of the
on?
above.
All of the all right, exactly. Or is he railing on Bitcoin and putting up memes of sexual rude like crude memes of Bitcoin, which he's actually done. If our listeners want to go through Twitter and look at Elon Musk and Bitcoin, there's some insane things out there. But I think if he focused, he would be exceptional. I forgot the gentleman's name. Another guy is 5 Hour Energy. The guy who made 5 Hour Energy is an exceptional leader. And all day, I would put bets on that company to make sure that it succeeds. And so when you do that, Michael Saylor is another one, right? With MicroStrategies, and the stock tripled because he went into Bitcoin, but it's not about Bitcoin. It's about the fact that he has a vision, and he was able to take a really hard decision, an unpopular decision, because he was really the first one. And so if I look at MicroStrategies, I'm evaluating it not only from what they can do as a company, but how Michael Saylor can lead the company and take advantage of future innovations, right? So if I'm investing on a micro level, which I am, these things matter a lot to me, much more than the actual business strategy. I mean, the business strategy is minimum bar, right? You have to have a good strategy. I have to agree with it. Then come earnings, then come the hard metrics. But I really emphasize the soft metrics in order to make my choice. And this is where past performance is, to me, is really really indicative of future expectations.
Yeah, you make a really good point, which is like past performance of an individual is probably very indicative, and I should probably spend some more time looking at leaders of different companies. Now let's talk about governments, though. So we know that governments are basically, they have a pattern of operating, and it's really really hard for them to break the pattern. But like, what do you think? Is there anything interesting to look at, like how governments have performed? Let's say, I think the big kind of tectonic shift was the fall of the Soviet Union, because like when the Soviet Union fell, the world became like a Pax Americana, unipolar world. And since then, everything has kind of been going in one direction. And now maybe we're moving to like a multipolar world with like China and Russia and like India and Brazil. And, you have many different like power centers. But like, do you think you can look at anything that the government has done and is planning to do in the future and then profit from that? And then I'll tell you what I think.
Yeah, I actually think no. I hear you on policy changes, but that to me, government is very prospective because governments change and can pivot so much. Like you said, the fall of the Soviet Union, that radically changed the way that government was structured. And while government seems slow and clunky, look at the U.S. and without commenting on what we've done in the last 4 years of the Trump administration, the U.S.'s policy going from multilateral to bilateral agreements, going from world first to U.S. first, is a drastic change, right? Even going back on some of our agreements with our neighboring countries, and so governments is a tricky one. It's more about, I think, macro kind of policy shifts, but I feel like governments have to react to the socioeconomic situations of its citizens. So if its citizens are suffering, or if there's a shock, like a COVID shock, you're going to reverse course real quickly, relatively really quickly, right? And you're going to print money or go into a war or pull out of a war or do whatever it is. And the massive scale of government action, where one move means tens of trillions of dollars potentially in economic effects, means that you can't really expect to just judge a certain continuing pace of things as they were and assume that they're going to go like that in the future. I don't know. Do you feel differently? Do you feel like you can judge past performance and project it out?
I feel that with governments, you can actually do it really well. The trick there, though, is to look at many governments together and not at one particular government. So I'll tell you what I mean. So, for example, I'm extremely bullish on China, and not because I think that the Chinese government is better, than the American government, but because I think that this is the first time when the Americans have an actual rival, and call it rival, call it competitor. Like, I think on many things, the Chinese and American governments agree, and like the disagreements are on kind of on the margin. If you look at like, globally, if you look at like Iran or North Korea, right, the distance between them and the US is much, much, much larger than the distance between China and the US. But one thing is very clear, which is China, right, is becoming a serious competitor to the US. And like, I have some friends here in Silicon Valley that work in China, and they go like to manufacture things over there. And they're like, yeah, when you come back from China to San Francisco, it really feels like you've gone from the first world to the third world. Like, San Francisco is the third world when compared to like really, really good advanced cities in China. Yeah, of course, I'm aware that it's like only the top cities, and, the countryside looks very different. But this is the first time, I think, in which the US has a serious competitor. And that's a good thing, right? If you think of the space race, for example, it wouldn't have happened unless the Russians sent the first man, into space and the first satellite and many other things. So I think, for example, this is something where we can look at the past trajectory of China and project it and then derive from it, okay, what will the US do in order to compete with that? And so I think the US can go one of two ways. One is protectionism, and the other one is just like accelerating its own development. I think protectionism just doesn't work. Like, it's been shown again and again to not work. So, like, to put like high tariffs and to isolate yourself, usually countries that do that, they lose big time. For example, one very stark example is India, right? So India, for many years, they wanted to be very isolated. They had really high tariffs, and they wanted to promote the local industry. Actually, the phrase third world comes from, I think it was Nehru, Gandhi's number two, kind of second in command, who said, we are going to be the third world. We're not going to be the first world, which is the US. We're not going to be the second world, which is the USSR bloc. We're going to be the third world, which will be better. And you see how it turned out, right? Like, it just, protectionism never works. So I think that in this sense, you can look at the past, chart the future trajectory of China, and say the US has to open up trade, has to like invest in research and development, because like, look, you can be very critical of the US government, and I'm not even talking about like the top, like the president, just like the whole government apparatus. I'm actually very happy with the US government, because like there's so many sensible people there that can get in a room and say, okay guys, we have a problem, this cannot continue like this, let's change it. And then they actually change it. You see a lot of the regulation around Bitcoin, I think, is that like, they know they could ban it, but they know that if they ban it, it's not going to destroy it, but it's just going to destroy the industry. So that's what I think.
Yeah, so I disagree with you here. I get what you mean about creating competition between the US and China, and protectionism versus being open to world trade. I agree there. Where I disagree is that I'm not sure that's exactly projecting the past onto the future. Or said another way, you're comparing a developing economy to a developed economy in the US. And sure, as a macro trend, developing economies will continue to develop so long as more or less the government is in power. But China, I shouldn't say, the government has set the right kind of policies there. But China is very unique, right? They have a more or less of an authoritative government that is pro-business, and they're picking and choosing winners in industries, and they're saying we're going to make Shenzhen, or we're going to make I don't know, Hong Kong now, or other cities very, very business pro business. We're going to invest a ton of money in there. We're going to make these manufacturing capitals of the world, and it's going to feel like the first world, and San Francisco is going to feel like the third. But that is, I think, too high of an altitude. If you look at Western democracies that are established, how can you say one Greek government, for example, will be indicative of the Greek government in 5 years, or even the German government, or even
I particularly didn't choose democracies. So what I said is, like, I look at China, I don't think they're going to become a democracy anytime soon. And so you could project their plan. They probably have a plan written down somewhere in some drawer, and they're just executing on that plan. That's why.
So you're saying centrally planned governments, you can project history to the future.
Yeah. Specifically China. I think you can. I think I have a lot more certainty in where China will be in 10 years than where the US will be in 10 years, just because like they have these long time horizons.
Well, fair enough. I mean, it's central planned government versus, I think, a democracy, and I'm using a democracy as my base case for saying I can't, because again, voters can vote a government in or out, and it can change fairly quickly. But
Yeah, but then you can say they can react. So specifically, I took China as an example. So China is a forcing function. Now the US can react to that forcing function. It can react in a successful way or an unsuccessful way. If they react in an unsuccessful way, then the government will change until you get a government that reacts in a successful way. So that was my point, which is like China is the forcing function, so we can predict what the US will do. Like, I would be and we spoke about this on the episode about regulation, I would be very shocked if the US broke down the tech companies Maybe they'll give him a slap on the wrist or something, but like I would be very shocked if they did something to hurt competitiveness.
Yeah, look, I mean, I think we somewhat agree, somewhat disagree. I still don't see how you can technically project the past on the future other than in a truly centrally planned government that says we're going to do X, Y, and Z and continue it. But how? Let's bring it back to investing, right? Let's say you can project the past and the future in a government from a governmental regulatory sense, and I do agree that the governments are not going to come after the big tech companies and really break them up. They'll get penalties, they get fines, but it won't be anything really substantial. When you're looking at, let's say, China as a forcing function to the US, what will that make you like? Have you seen China before be a forcing function of the US, or is this something different?
No, the USSR was the previous forcing function.
So you're
That was
saying
the only one.
so you're saying vis-a-vis democracies, you can project that there will be uh, developing countries that are forcing functions as they develop and become bigger. In a certain way, they force the Western developed countries to become better at X or Y.
Exactly, exactly. I think that if the US would have suppressed China more, it would have hurt the US. Not directly, but indirectly. And by the way, I think that's another thing. Maybe I'm like too kind of enamored with with the U.S. strategic planning. I just know, back in the day, I learned a little bit about strategic planning and stuff, and it's almost like you have to be a professional in that, and you can kind of come up with all of the scenarios and like have a good reaction to every scenario. And I think the US is actually really good at that. The only times when the US wasn't really good at strategic planning is like when they just did some blunder because like one person forced it, like, the wars in Iraq and Afghanistan, or like the Vietnam War. It was kind of like forced by someone, and then they kind of had to muddle their way out of there. But if you look at things that the US actually plans, we're pretty good at it. So I think, yeah, there'll be a forcing function. And to bring it into very concrete terms, I would invest in areas that are open to competition from China, as opposed to areas that are not open to competition from China. So, for example, medical devices, I would not invest in, because like you have the FDA that can like stop, things from being sold to consumers here. But like software, I would definitely invest in software, because like there's no you don't have to get a license to sell software. So that I think is a very good thesis of like just invest in things that are open to competition. It's almost like if you want to choose like a warrior to compete in some boxing match, you have one person that like grew up in the wild and was like, constantly exposed to like stimuli from the outside and challenged, and someone else who just like trained in a gym like all his life and was kind of very protected. I would bet on the person that has been exposed to challenges. So that's like my investment advice. By the way, this is not investment advice. It's for entertainment purposes only, and we're not licensed.
This is
Uh,
my
advisor.
only investment advice. So you basically want to go for the wild child. Invest in the wild child, says Shimon, versus the groomed kid from a privileged neighborhood.
Yep, exactly.
Okay, I like that. I like that. I like investing in a wild child as well.
Yeah,
So
and I just want to mention two more things, which is like one, when you look at a trend, I always like to look, is this a secular trend that's non-cyclical? In which case I pay attention to the trend. If it's a trend that's either cyclical or non-secular, and by the way, secular, I was confused by this term. So a secular trend is basically a trend that happens regardless in whether you believe in it or not, right? So just like a secular person doesn't need like the priest to tell him what to do. So a secular trend, for example, commodities prices have been going down, down, down every single year. And it makes sense because like technology makes it cheaper to produce commodities. Like, yes, there are spikes. Yes, like things can happen, but like overall, a 400-year trend. Another secular trend, capital. The cost of capital is going down I read a book, right? It's like literally you have more capital, so the cost of it is going down. You accumulate capital. So those two trends, I would definitely note them, and I wouldn't invest in anything that goes against them unless there's a really, really, really good reason. And even if you have a good reason, I'm probably not your guy, because like I don't know how to time those things. I don't know, right? It's like if someone were to say, okay, energy prices are going up right now, I'm like, okay, but how do you know that it hasn't been priced in already? Like, I expect energy prices to just keep going down. So those two things are also something that I would look at past performance and just not go against them.
Well, look, I think we discovered and discussed a lot of interesting things, ending with government regulation, but looking at going macro and micro altogether. We've talked about looking at P ratios as a big macro view, and can we project the past and the future? And we both agree that you cannot, because it's all about what the future will bring. And then I think we bifurcated and we said, look, if you're a micro investor and you're looking at individual companies, then you should look at performance of the growth of the company, but more specifically, leadership. Does it have a leader that's brave, that can take risks, and that has done it before? Does that leader's past success? Is there a track record of it? And then on the macro level, is being a little bit counterintuitive and thinking and looking at how do developing economies force the developed economy to act, and actually investing in areas where the competition is much more intense, specifically from the outside world, than not. Because when the competition is more intense, the companies are forced to become better, wild children, if you will, and then will be better in what they do. And secular and cyclical trends are also a good indicator of the future. So, look, this has been Alex Jirzik and Shimon Lazarov at Mr. Ibida and at Shimon Lazarov, respectively, on Twitter. Thank you for listening to us. Please leave your comments, likes, and what you would like us to discuss next. Please go on the website, hardcorefinance.com. We appreciate any donations to keep the podcast going and for us to bring in other information to you. And we now recently have really cool swag. So take a look at face masks, yoga pants, iPhone, cell phone covers, t-shirts, and other things. Show off your hardcore finance gear. And until next time, thanks, Shimon.
Thank you, Alex. It was a pleasure.